Well, welcome back. U.S. banks are set to report their earnings in upcoming days. Our next guest is bullish on U.S. financials. She also likes big industrial names. Let's bring in our next guest, Victoria Fernandez, is Chief Market Strategist at Crossmark Global Investments. Victoria, thanks for joining us. The launch of bank earnings season in the U.S. is always a big event for investors in the U.S., in Canada, and in fact for around the world. What kind of quarter do you think it will be for the big U.S. banks?
Yeah, well, we've seen a lot of improvement in banks' balance sheets. It's one of the reasons that we really like this sector. We've liked them for all of 2024 as well. They were hit pretty hard in 2023. You had an opportunity to get in there, and they've just continued to do well. And when you look at opportunities going forward, which, guidance when it comes to these earnings calls is really what drives the stock price, you're looking at a time of possibly more deregulation. You're looking at a time of possibly more loan growth as CapEx continues to go well. These companies have, like I said, strong balance sheets already, so they're sitting in a very good position. And we look at the yield curve and what we anticipate will happen to the yield curve in 2025. You have this steepening of the yield curve, 2s to 10s over 40 basis points this morning, the steepest that it's been in quite a few years. So there's a lot of potential for banks and financial companies to continue to do well here. And you can look at not just big banks, but you can look at some of the financial services companies and the gains they've been making in contactless payments and technology. Again, room for growth there.
You draw an interesting connection there between expected loan growth and capital spending. Is the connection you're making expectations that U.S. companies at large will dial up their capital spending and therefore require financing from Wall Street?
We do think that we're going to see that, Paul. I mean, it's been pretty muted for the past year. A lot of that because government spending in the U.S. has been so high, and that really dampens the capital spending component. But if CapEx increases, and we think some of that will be due to onshoring, we have a lot of U.S. companies looking to reshore some of their supply chains. As that happens, we're going to have to see CapEx increase. So yes, I think that's one of the main reasons that we will see loan growth improve. And if yields come down throughout the year as the Fed looks to lower rates, then I think that will help from an individual perspective as well.
Okay, you like a couple of other financials as well. One is MasterCard, the credit card giant, which is a payment processor, and the other one is American Express, which is a credit card giant, which is actually a lender to its clients. Talk to us about those two stocks.
Yeah, so when you look at MasterCard, they had a phenomenal quarter last quarter. We think we'll see that again. Cross-border transactions have been extremely high. And even though you hear stories about delinquencies moving higher, for MasterCard, it's been very small that that's happened. And they're making a lot of progress on the technology side, as I mentioned a moment ago as well. Their return on their equity is high. Again, solid balance sheets and good cash flows for this company. So we think that can be a good long-term holding in your portfolio. And we know that at least in the U.S., it's the high-income consumer that has been doing so well and really supporting this economy. That caters to American Express. That's who those clients are. They continue to spend and to travel. And so we think American Express can continue to do well in 2025 as well.
And as we've shown viewers, you also like a couple of industrials, and they are iconic names indeed, both Deere and Cat. The conventional thinking on these stocks, of course, is they're very exposed to economic growth in the U.S. and indeed globally. Is that part of your thinking here?
It is part of our thinking, and we know that we have GDP expectations in the U.S. around 3%. That probably will come down a little bit this year, but tie that into what we were talking about for some of the banks in regards to CapEx increasing. We need to see manufacturing come back. We're hoping that maybe we've seen a bottom in some of the manufacturing numbers, that will continue to grow, that housing will start to have a rebound in 2025. Both of those sectors have been at very low levels for 2024. So if we see upswings there and CapEx continue on the corporate side, then I think you've got some industrial names that can do well.
What areas of the U.S. stock market are you avoiding right now?
Well, there's a lot of areas that have some uncertainty surrounding them. Healthcare is one of the ones that we would just be cautious of. Energy has really been struggling. We think it can do better in 2025 than it did in 2024. But again, as a new administration comes in and new policies go into place, healthcare and energy are two areas where you could see some policy changes coming into play that could affect profit margins and earnings for those two areas of the market. So we would just be cautious on those two right now.
Victoria.